Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and welcome to Wednesday's programme for the 12th of July. This is Peter Lewis with the original Money Talk and one of Hong Kong's most listened to financial podcasts, as well as listening at peterlewismoneytalk.substack.com. We're also on Apple Podcasts, Google Podcasts and Spotify. You can also find the show on Facebook, Instagram and also on Threads now by going to Peter Lewis Money Talk. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, President Xi Jinping has called for a greater opening up of the Chinese economy to focus on foreign cooperation in areas including trade and investment. CCTV quoted President Xi as saying in building a new development pattern and promoting structural opening up, key areas of foreign exchange and cooperation such as investment, trade and financial innovation should be focused on. China's Global Times claimed yesterday that there are no deflation risks in China as consumer prices are expected to rise in the third quarter with more policy stimulus to be rolled out to reinvigorate consumption activities. The commentary came a day after China's National Bureau of Statistics reported that consumer prices were zero in June and producer prices fell by the most in 7.5 years. Microsoft has moved closer to securing its $75 billion purchase of Activision Blizzard after a US federal judge rejected the Federal Trade Commission's request for an injunction to halt the deal, and the UK's competition watchdog signalled it was open to discussing the merger it had previously rejected. Foxconn has pledged to go ahead with its chip-making plant in India, a day after quitting a joint venture with local partner Vedanta. A Taiwanese electronics manufacturing company said on Tuesday that it was committed to India and the country sees the country successfully establishing a robust semiconductor manufacturing ecosystem. The company added that it was actively reviewing the landscape for optimal partners. On today's programme, I'm joined by Hal Hong, Chief Economist at Grow Investment Group, and with a view from Japan is Nick Smith, strategist at CLSA in Tokyo.
Peter Lewis's Money Talk.
US stocks rose on Tuesday as investors welcomed comments from Federal Reserve officials suggesting US interest rates may be nearing their peak. The S&P 500 rose 0.7% to end at 4,439. The Dow advanced 317 points, or 0.9% to close at 34,261. The Nasdaq Composite gained 0.6% to 13,761. Activision Blizzard's shares jumped 10% after a federal judge denied the FTC's request for a preliminary injunction to stop Microsoft's acquisition of the video gaming company. Treasuries were mixed in a quiet day of trading. The 2-year Treasury yield was up 2 basis points to 4.89%. The yield on the 10-year Treasury was trading 2 basis points lower at 3.98%. And it's worth noting that 3-month bill yields are back at the highs of late May in anticipation of another Fed rate hike. You can lend to the US government for 3 months at 5.44%. And that leaves the spread between the earnings yield on the S&P 500 and 3-month bills, which are already at the worst since the dot-com bust, at a fresh low. The earnings yield on the US tech sector is more than 200 basis points lower than the yield on 3-month bills, and that's comparable to the end of the last tech bubble in the year 2000. The US dollar index touched a 2-month low as traders reacted to a flurry of commentary from Fed officials, which hinted that the end of the rate hiking cycle may be approaching. Sterling rose to a 15-month high of 1.29 1/3 against the dollar after stronger than expected UK wage growth added more pressure on the Bank of England to keep on raising interest rates. The yen continued its recent strength, advancing 0.7% to 140.35 against the dollar. The Chinese yuan extended gains into a fourth day, rising 1/3% to 7.209 renminbi in Shanghai. And Chinese stock markets advanced. Following the announcement of property support measures, Hong Kong's Hang Seng Index extended its gains from Monday, rising 100 points or 1% to 18,660. The Hang Seng Mainland Properties Index surged as much as 3.2% before giving up all of its gains to end the day unchanged. And the tech index climbed for a second day, rising 1.5% as investors were optimistic that the 3-year regulatory crackdown on platform companies was over. Alibaba climbed 2% and Tencent added 1.5%. On the mainland, the Shanghai Composite gained 0.6% to 3,221. Goldman Sachs reported yesterday that global hedge funds turned net buyers of Chinese stocks for the first time in 7 weeks between June the 30th and July the 6th as they covered short positions. And this morning, futures markets are projecting the Hang Seng will open about 50 points or 1/3% higher. You can get the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
And I'm joined now by Hal Hong, who is Chief Economist at the Grow Investment Group. Morning, Hal.
Good morning, Peter.
Let me ask you first of all about the Chinese economy. President Xi Jinping yesterday called for greater opening up of the Chinese economy to focus on foreign cooperation in areas including trade and investment. The Global Times claim there's no deflation risks in China for the full year. They say consumer prices are expected to rise in the third quarter with more policy stimulus to be rolled out. Of course, how that doesn't really chime with the data that we saw. I did it earlier this week, which suggests deflation is a real risk. Do you think that's a concern now that we should be worried about?
Yeah, I think it's a reflection of how weak the domestic demand is. Despite record lending statistics that we saw in June, the consumer inflation still trending down, and also in the upstream sectors, the inflation PPI has been decelerating for some time now. So now it's like around -5%. All right, so there's a persistent deflationary trend in the upstream sector, and then downstream is also going into a deflationary zone because of weak demand. So I think even though we're hoping for more stimulus in the third quarter, and therefore it could jut the CPI out of this deflationary danger, but the fact is that monetary policy works with a lag, right? Mm-hmm. So, and also because previously we had record lending, and it's still not enough to help the CPI to come back to inflationary, sort of a mild inflationary environment. So I think we're just hoping for too much. That if we're betting that there will be more stimulus, therefore the CPI will come back.
Why is demand so weak on the mainland? I've heard explanations comparing it to Japan, the balance sheet recession that Japan had in the early 1990s, where people were more focused on reducing debt, cut back on their spending to do that. Is that partly what's going on, that the property market slump is having a real impact on people's sort of psychology, if you like?
Yeah, I disagree with the consensus assessment on the balance sheet recession explanation of what's going on right now. Just now I mentioned that lending is still a record high. We just had, I think, one of the highest June in recent years in terms of new loans made by commercial banks. Therefore, someone is borrowing. And also, I think the consensus is really focusing on the household of China, who is really paying down debt, because in the past 3 years, they have leveraged up so much. And also, they bought up quite a few of the properties, and now they are finding it, a little hard to buy even more properties, right? So onto their existing portfolio of properties. So the households are retrenching, but then corporate sector, on the other hand, is borrowing, and also in the months of June, we're seeing more than 40% of new lending is going into the longer term loans, right? So which is also a good sign, meaning corporates are making longer term commitment, to expand the business. So I think given all the information that we had, it's too. It's almost like wrong to conclude that we're in a balance sheet recession right now. Right? So it's very different from the Japanese setup 30 years ago. But then, having said that, I'm not saying that we're not going to enter into a balance sheet recession. I'm just saying that right now, with all the numbers that we have, it doesn't support the consensus posit of we are in a balance sheet recession. And I think also one prominent feature with the Japanese balance sheet recession 30 years ago was that it has a real estate bubble burst. One can argue that Chinese property price is very high, and therefore it's at risk of bursting. Right? So, but I think right now we're just not seeing dramatic real estate price decline across the board, and therefore, the necessary condition for a balance sheet recession is just not here just yet.
I suppose it depends where you look, doesn't it, in terms of the housing markets. If you look at Tier 3 and Tier 4 cities, then things look pretty grim. But if you look in the Tier 1 cities, the prices seem to be holding up pretty well.
Yeah, I think Japan is going through the same sort of process in the past 30 years, as they work off its real estate bubble. Right now, Tokyo property prices back to where it was 30 years ago at the peak of the bubble. But then, many lesser sort of developed, lesser popular cities, they're like, still 40 to 60% down, from the peak. So that is telling you that, core sort of location, core metropolis, with the attraction, to attract population growth, they will have price support. And I think, China is more or less the same. Tier 1 city, we're still seeing, price are relatively firm, and also, people are still buying. They're not, completely stopping. They're still buying as, new immigrants, going into the cities from other lesser developed cities, also from a rural area. So I think, experience told us that the area of this Tier 1 metropolis will continue to expand. And I think, Beijing has like 30 million people. Shanghai has 30 million people. I think Guangzhou is like 25 million people. Shenzhen more or less the same. And these cities are set to expand even bigger. All right, so I wouldn't be surprised to see, in the next 5 to 10 years, they get to the 50 million population in size. Mm-hmm. So that means, a lot more demand for properties in these cities. But then it also means that much less demand, for properties in other cities.
So what do you make then of the proposals or the announcements to try and support some of these beleaguered property developers, with the regulators putting pressure on banks to try and support them and extend outstanding debt and trust loans, give them an extension? Is this going to make a significant difference?
Not really. I mean, if you look at the Chinese property policy, right, so it always focuses on the supply side of the equation, right? So, right now it's trying to help developers to finish all the buildings and give it to, the buyers. So, in a sense, it's trying to help developers to, sort of finish the job. And also, because many of the developers are having cash flow problems because of sales slow down, right? So they can't recycle the cash as fast as they used to be. And therefore, there are problems with their cash flows, and therefore, the central bank is trying to help, which is admirable. So, I think this is not a new policy, by the way. I think ever since late last year, I think from November, December, we've already seen the PBOC trying to sort of extend loans for, telling commercial banks to extend loans for developers, telling them to sort of temporarily put aside, these loan issues and try to help them as much as possible. But it's really focusing on the supply side and trying to bail out the developers. But I think what we're facing right now is the problem is substantially larger than the supply side problem. We have a demand side problem, which is the issues that I mentioned just now. We have strong demand in the Tier 1 cities, but then for lesser developed cities, people are actually moving out.
But what does this mean then for the banks that are extending that loans? We've had this infamous sort of reports from Goldman Sachs, didn't we, last week, a rather bearish report on Chinese banks, which was quite pessimistic about their exposure to local government financing vehicles and their debt. What does this all mean for the banks? Is this an area that we should be concerned about?
Well, the LGFV has been a sort of a dangling issue on top of many of the Chinese banks, right? So because historically, how the local government get to develop their business is really through land sales. Because in 1998 there was a tax reform that make the local government submit all the most of the tax revenue to the central government, and then at the same time they get to keep the land sales proceed. So land sales proceed sometimes can be as high as 100% of the local government revenue source. So right now, the problem is that once again, because property sales is slowing down, no one is buying, a big block of land. So on a already very low base last year, local government, is letting them the land sales proceeds, 30 to 50% lower than last year, which is a very low base to compare with. Right. So, therefore, you have a revenue problem, right? So many of the local governments are now, in deficit, and some of them find it difficult to pay out salaries to public servants.
And how?
So I think it's substantially larger than many people could imagine. The issue. So I think the PBOC can extend long terms, low interest rate. Telling the commercial banks not to recognize the LGFV as bad debts. So as not to impair the commercial banks' ability to lend, etc., etc. There are like a whole series of action needs to be taken. But I think right now, the Goldman Sachs report really is to raise an alarm bell on this issue that has been around for years.
I mean, it certainly did raise alarm bells, because we had even Chinese state media sort of chiming in and saying that the report was unrealistic and people shouldn't be focusing on the non-performing loans at Chinese banks, which of course then makes people immediately focus on them and wondering, well, why is there a problem here?
Yeah, well, the media obviously is trying to shore up confidence, right? So they're trying to help out the bondholders, tell them to sort of take it easy sort of way. So I wouldn't pay too much attention to what the state media has to say. Yeah.
So what should the government do? We've got an economy that's faltering. The domestic demand is falling. Exports are under pressure. We've still got the problems in the property sector. We've got signs of the economy entering into deflation. A lot of people waiting for stimulus, but so far no big announcements. Do you think we will see, maybe at the Politburo meeting, some sort of big bazooka be rolled out? What do you think the Chinese governments could do?
Yeah, no, I think, people are really focusing on, the numbers are not up to expectation, but, the numbers are substantially better than last year. If you're traveling now in China, so I've been spending, weeks of my time here in mainland. I'm calling from Shandong, which is a tier three city in China, right? So I'm seeing like a very good, strong foot traffic across the board. Hotels are really booked up. Restaurants are like really busy and all that, right? So it's substantially better than last year. So I think one should focusing on how much marginal improvement we're making this year, instead of how disappointing the economic data has been, because we have very high expectation for reopening. Right. So I think that one has to make such a distinction, and also I think over the last 10 years, in particular. In the last 10 years, whenever there's slow down, then we try to step on the gas and trying to pump stimulus into the system, and I don't think that's the right way to do it. Right, so I think for the past 30-40 years, China has been focusing on a relentless growth target every year, and move all resources so that we can sort of protect and then get to the growth target every year. But it's a very different approach to economic management from the other economies, who are focusing on inflation and unemployment, right, and financial system stability, right. So I think if we could sort of move away, from a growth focus model, into a more sort of, the price stability and financial stability and employment stability model, then I think, it will be more beneficial to the Chinese economy. So I think right now, all this disappointment is coming from, the fact that, we get used to a rapid growth model, and then suddenly, last year we're growing at 3%, and this year 5%, and people sort of, finding it hard to get used to. So I think right now, it's not a problem of, rolling out bazooka, to stimulate the economy, and then later on, we deal with the excess capacity and all the debt issues. But more importantly, how best to re-engineer the growth model going forward, and also, shift the mentality, from a growth-only model into a more balanced, all-inclusive growth growth model.
So investors seem to be waiting for two things to happen. The first one is an improvement on the geopolitical fronts. Now, President Xi Jinping called yesterday for the economy to focus more on foreign cooperation in areas including trade and investment. And of course, we had Janet Yellen's trip at the end of last week to Beijing. Do you think, as a result of that, and maybe as a result of what President Xi Jinping is saying now, that the geopolitical situation is improving and that tensions between the US and China, even if they haven't gone away, at least there's a flaw underneath the relationship now?
Well, there has to be. I mean, China is still, the most important trading partner with the US. The US trade deficit against China is a record high. And also China is one of the largest US treasury bond holders. And therefore, it pays to have a good relationship between the two countries. And, I know that, in the technology arena, people trying to rival each other, to get ahead in terms of AI and cloud computing and all that, and also the semiconductor industry. But the thing is that it's understandable that the U.S. trying to protect its intellectual property, but then at the same time, because the Chinese economy has grown to a substantial size, and just now, we mentioned that we need to find new growth drivers for the economy to move forward, right? So obviously, in the future, technology would be a sort of a big part of Chinese growth model. So I think even though there are curbs in terms of technology exports from the US side, but it would be hard to imagine for all these curbs to stop China from developing its own technology. And also in the past 10 years, we've seen some technology giants emerging from the Chinese economy. For example, Tencent, Alibaba, Huawei, just to name a few. So, one has to realize that it will be really hard to sort of, stop one country to develop its own technology. So, I think, the dialogue should be sort of resumed after Yellen's visit and also after Blinken's visit. And also, the more dialogues between the two sides, the more understanding, and therefore, the better relationship. And also, it would be best for the global economy as well, as global central banks are tightening monetary policy, right? So, economy bound to slow down, one way or the other, right? So if two of the biggest economies are focusing, having a go at each other, right? So I think it would be harmful for global development. So I think, I think both sides understand this. I think, surely there will be more dialogues going on, trying to understand each other's issues and, maybe, get to a middle ground, in some of the key issues that we're facing.
And what do you make of the crackdown that we've been seeing over the last 3 years on the big technology companies? There's a feeling that maybe that's come to an end with this $1 billion fine, almost $1 billion on Ant Group. Is that your assessment as well, that maybe this 3-year sort of regulatory oversight of the big platform companies is now over, and there's going to be more support, in particular for private enterprises, to develop and grow, because they've been under pressure a lot, haven't they, recently?
Yeah, I think those are like the final verdict for, many of the big tech firms. The fine is huge, and also it impaired the valuation of many of these tech giants. Now they're like 80% down from its peak. So, it's good news in a way, but, having said that, people interpret it as, wow, this is the end of the regulatory blow to the big tech giant. But, the fact is that, the big tech giant has already slowed down way before this, right? So in terms of the sales growth now, it's a single digit. For example, if you look at Alibaba's sales growth, Pinduoduo sales growth, it's at its lowest in years. And also, in terms of how they're using their cash, to develop new technology, they're slowing down as well. And also, many of the big firms are, trying to break up, in a way to unlock value for shareholders. But then at the same time, because of this breaking up, you may get less synergy between groups, right? So development will be substantially slower than before. In the past 10 years, I think, can be characterized as, one of the breakneck speed development for, many of the big tech firms in terms of technology. but now, noticeably it's slowing down, right? So, I think it's good in a bad, but, if you think that, this big fine is going to put a full stop into the regulatory actions against the big tech giants, I think, it's a little hasty to draw this kind of conclusion, because the regulation will be ongoing. And also, way before this, I think the big tech giants have already slowed down.
Okay, well, let me ask you finally what this all means for the markets, for the local markets here in Hong Kong, for the mainland China markets, which have really been under the cosh, haven't they, over the last few weeks by these problems and the slowdown in the economy. Also, we've seen foreign investors really pull out of the market in droves. Where does it go from here?
Yeah, I think, the foreign investors has been, selling down their Chinese holdings for months now. I think mostly for compliance reason, and also many are rotating their portfolio to the Japanese equities, who's showing very promising returns and having one of the best years in 30 years. Right? So you can't blame them. They're like money to be had in another market. That is developing itself into the alternative center for a new supply chain. So I think, it's understandable. But then having said all that, the Chinese market, both Hong Kong and Shanghai, already improved substantially from late last year. Right? So we're like, 20% higher, well, more than 20 to 30% higher than last October, where we see the lows for this cycle. And I think that low will hold in this round. So even though now I think, Chinese equities don't look attractive, because sentiment issue, because of compliance issue, because the attraction of a new competitor on the horizon. But I think over time, people will come around to realize that, growth is still here, right? So just now we discussed many things about China's growth going forward, property problems, municipal bonds problems, et cetera, et cetera. They all have solutions. I think, in the past 40 years, China has stumbling its way, to where it is today now. And I think going forward, one shouldn't doubt, China's ability to innovate its way out of this quagmire. So I would say that I think right now, the market is under pressure, but I think, for longer term investors, it pays to take another look at the Chinese equities.
Hao, it's always a pleasure talking to you. Thank you very much for your thoughts there. Very interesting indeed. That's Hao Hong, who is Chief Economist at Grow Investment Group.
Peter Lewis's Money Talk.
I'm joined now by Nick Smith, who is Japan strategist at CLSA in Tokyo. Good morning, Nick.
Good morning, Joe.
I wanted to let you have a piece of information that we have here from China, actually. According to Goldman Sachs' Prime Services Unit, hedge funds sold Chinese equities in June for a fifth consecutive month. They've now unwound more than 70% of their buying during the initial reopening euphoria that we had here between November and January. And what we've found is that, or what Goldman say, is that capital is being deployed to Japan. It seems like, doesn't it, that a big part of this rally that we've been seeing in Japanese stocks is being driven by money coming out of China.
Yeah, it certainly seems that way. I was surprised. If you look at the movements in the market so far this year, you see China coming down, Japan, Korea, Taiwan going up. A lot of money going into Japan, so $71 billion so far this year. From the lows of late March. The interesting thing I thought was that if this was a geopolitical, not China trade, then you would have thought the money would have come from the US, and it hasn't. So of April and May flows into Japan, 76% came from Europe, and most of the remainder from Asia X, which was not what I expected to see.
And it's interesting that we've got clients who are concerned about the sort of the mix of geopolitics and slowing Chinese growth, who are moving investments out. We've been seeing this call for MSCI Asia ex-China funds, sort of mirroring what we saw, wasn't it, back in the 1990s when we first started to see MS China Asia ex-Japan funds. But people now seem to be calling for funds that specifically sort of underweight or have no exposure to China.
It's it's an odd trend. I mean, obviously, for most people, Japan and China are in different buckets. Japan's an EFI bucket, and China's different. But nevertheless, yes, there does seem to be something of that trend.
And what about foreign investors into Japan? We've talked many times on this programme about how underweight they are. Are they now catching up, or are they still underweight despite all of this buying that we've been seeing?
Well, I mean, I think if you look at the numbers from the first week of June 15 through to the end of March this year, foreigners sold broadly $250 billion. And then of that 71 billion worth of buying, about a third was seasonal. So let's say they sold 250 and bought 50. So I think the overall feeling is that they're underweight Japan quite a lot at the moment.
So do you have a sense of, I know it's very hard to put targets on these things, but, you know, the Topics has had a good run. So is the Nikkei 225. How far do you think it can go? Do you think I'll ever see again that peak in the Nikkei 225, which was just above 38,000, wasn't it, back in the end of 1989, just as I moved out to Japan, in fact? Am I ever going to see that peak again?
Happy days. I think, well, obviously the 89 peak was a bubble that made 1929 look like a walk in the park. I mean, as a percentage of GDP, the bubble was 4 times as large. So, in a way, you might say, I don't know what the Americans were fussing about. Now, this is a real bubble. I think we're coming back now. If you take your valuations and you adjust for the difference in interest rates, then Japan really is, in terms of earnings yield minus bond yield, Japan is still a very cheap market. I just don't want to give the story of Japan as cheap, because I think it's so very much more than that. So if you use cyclically adjusted PE, taking out the effects of that cyclicality, it still looks very, very cheap. 20 times as opposed to 30 times for the US, and we're not even factoring in the interest rate differential. But it's got a growth story when others don't, because of its late reopening. And some people argue that the currency helps, which is very weak at the moment. So we're at sort of 140, whereas in 2019 we averaged 109.
Okay, so for listeners who are wondering how we're doing that, by earnings yield, we mean in effect the inverse of the PE ratio, don't we? That's really what drives the earnings yield. But you can't just compare earnings yields across different countries. You have to take into account the difference in interest rates also between those countries. But what you're saying is that if you look at the earnings yield and compare it to, say, 10-year bonds in Europe, Asia, the US, it looks very attractive from a valuation perspective.
Absolutely, yes. Excuse me for being nerdy.
It's all right. No, I just want to make sure that people are listening are understanding what we're saying here. And what about inflation? I mean, that inflation's accelerating, isn't it, in Japan? It's at a 40-year high, I think, now, isn't it? And also quite a way above the Bank of Japan's targets. What's the impact of this going to be?
Yeah, I mean, I think people in the US and Europe say that inflation doesn't feel particularly large compared to what we've got in our countries. And I suppose the answer to that is, sure, but Japan hasn't had a pay rise in 30 years. So the rise in prices is really painful. The BOJs try to make an argument that inflation is A, transitory, and B, imported. And for well over a year, I've been arguing that it's neither. And I think in recent days, BOJ Governor Ueda has been admitting, yes, it's not as transitory as we thought it was, and it's more domestically driven than we thought it was. So he's coming around. One feels that there's a political element in this. So the government does seem to want to continue to spend like drunken sailors, and says they don't want to hike taxes. So please, could you, BOJ, just print a little more for us? Obviously, Japan knows better than pretty much anybody the dangers of doing that with what it did in the 1930s. So I feel that we're getting to a point where the BOJ's got to take away the punch bowl. I think that increasingly it's been clear that the inflation we're getting in Japan is the result of demographics, that tightening labour markets, rapidly tightening labour markets are forcing wage hikes that we haven't seen since the early 90s. And the result is companies are passing that on because why shouldn't they? Their real effective exchange rate is very weak indeed.
So when you say the BOJ is going to take away the punch bowl and Governor Ueda is coming around to the idea, does that mean basically the end of this famous yield curve control?
Well, I think it does. I think the BOJ has a meeting at the end of this month. They are tabled to adjust their inflation forecast at that point. Their inflation forecasts at this stage look a little bit la-la land. And so just a smidgen of honesty would result in them revising them up very considerably. And that feels like a sensible point for taking away yield curve control. I mean, I think Ueda has said we either take it away or we keep it. But if we fiddle with it, as we did on the 23rd of December, we attract laser beads on our forehead from every speculator globally. So I think the chances are that it's taken away at that point. I think there are quite a lot of reasons for thinking so.
So that's not the consensus forecast, I don't think, is it, in the markets, where that maybe yield control is going to, curve control is going to remain for a while, but you think it could be gone within the next month or two?
I think there are. I'm not particularly unusual in thinking that that could happen. I mean, I think the pushback you get from people on the other side of the world is, well, the Japanese take forever to decide on anything, and the answer is beware.
So what will that mean for the markets? Because the last time the Bank of Japan adjusted their yield curve control, and they only made a small tweak to it, it caused chaos in the markets, didn't it, really, in the bond markets and in the currency markets?
Well, I think so. And this time, the chances are that it will be an even bigger bang, just because it's the real change, the finally taking out yield curve control. The yen will strengthen. One would have thought it'll overcompensate. So perhaps we see 125, something like that. There are a lot of people in Asia X who think that Japan depends on a weak exchange rate to make any money. I think they'll be surprised. They should look at data going a little bit further back before central banks messed with the interest rates. I think the biggest shock is going to be when the carry trade reverses. That's an extremely large trade. I think it has given cheap financing to people all over the world. Who's going to be affected by it? I think in this particular case, it's been there for so long that you're not going to see who's been swimming naked until the tide goes out.
So the yen, in effect, it's very strongly correlated, isn't it, with that yield differential between the US and Japan. So I suppose that, I mean, the yen's strengthening at the moment now from what a 7-8 month low. I suppose the risk is, what people should be watching is this US inflation data tonight, because if that surprises to the upside, then the yen goes back down again.
Well, I think another way of looking at it, though, is that the BOJ have been sitting there feeling very comfortable that they're at the point of maximum strain, that the US won't hike anymore. And the Fed's been saying, well, I think there are probably 2 more hikes to go. And so, if it were done when it is done, then it were done quickly. They really need to make this change kind of nowish. It's only going to get harder when the Fed gets further hikes. Then you'll see more pressure on the Japanese bond market, on the currency market. You see the yen weaken. There'll be extreme frustration inside Japan about imported inflation becoming an issue at a time when wages aren't keeping up with it. It's understandable that Japanese voters say in their polls, criticising Kishida, say, it was cheek of you to have the Bank of Japan print money to drive up prices without any plan at all for getting wages up.
Now, the other thing that I finally wanted to ask you about, obviously shareholder activism has been a big factor as well, hasn't it, driving these gains, this name and shame campaign by the Tokyo Stock Exchange. We had a development, I think, with Cosmo Energy. They stopped their largest shareholder from actually voting at the shareholder meeting, put a poison pill in it. Has that sort of knocked on the head a bit, the excitement over this shareholder activism?
Well, I think it's going to bring some things to a point. So, excuse me for being a little bit geeky, but the excuse they use for this is bringing something that exists in other countries to allow them to exclude one shareholder from the voting is the majority of the minority. Now, that's used in countries like the US when the buyer is the management themselves or someone aligned with management, a management buyout. And so, not surprisingly, other shareholders need protection against the knowledge of inside buying. This is the exact opposite. This is protecting management from its own shareholders, precisely what the law wasn't intended to do. So, this is going to be the acid test. Merging Cosmo into a larger oil entity, which is what the activist is trying to do, is absolutely necessary and in line with what the ministers have been talking about making M&A easier. But will their hate for this particular activist be so large that the legal case will go against him? If it does, I think it's incredibly bad news for Japanese activism.
Okay, but the upshot of all of this is that basically, I think what you're saying is really the Japanese market, Japanese stocks still look pretty attractive despite the rally we've seen so far.
I think so. I think they're pretty cheap and they have a growth story in terms of reopening. So lots of things to like about the market at the moment.
That's Nick Smith, Japan strategist at CLSA in Tokyo. Thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll be back tomorrow when I'll be joined on the show by Andrew Ferris, the CEO of Economist Advisory, and Nick Marrow, lead for global trade at the Economist Intelligence Unit. With a view from Taiwan is Ross Feingold, Business Development Director at SafePro Group in Taipei. See you tomorrow.
Money Talk.